Great. So I'll go straight away into the presentation. And so what do you consider before investing? So you just wake up one day and you realize, oh my God, I should have been investing. But then where do you start? And I think this COVID pandemic has really made people realize that maybe I should have been saving or I should have been investing. So now that you want to do it, then what's next? What should you consider? What are the things that you should look into before you start investing? Because investing itself needs to be well planned, because if it's not well planned, it could end up being a disaster. But if well planned, it could actually help you grow your wealth in a very nice way. So we'll go to risk versus return. And return is a reward for risk. So the higher the risks, then definitely the more the return. So whenever you look at something that's giving you a huge return, then you've got to know that risk is higher. But risk, and you see sometimes people feel like risk is only the risk of losing money. But risk doesn't necessarily mean that because you're getting a higher return, you might end up losing all your money, or the risk of losing your money is high. I'll give you a very simple example that most of the Kenyans in the diaspora would be quite familiar with. And this example is real estate. Now, we all know that real estate has a high return. So, but does it mean that real estate is risky? Okay, so number one, yes, it's risky because the return is high. But is it risky in the sense that you'd end up losing your money? No. So the risk you have with real estate is, number one, the risk that you may not earn what you expected. So for example, we say the average return over the last 10 years in Kenya for real estate has been about 10%, sorry, about 25%. But when you invest into real estate, there's a risk that you may get the 25% or you may not get the 25%. So that in itself is a risk. So you might end up making 40%, but you might end up making 7%. So that's the first risk. It's called the risk of not realizing what you'd expected, or shortfall risk, right? Then the second type of risk is liquidity risk. You can invest in real estate and you can make a really good return. But what's liquidity risk? You may not be able to convert the investment that you have into cash as quickly as you would have wished to. So for example, if you had shares, you can sell your shares tomorrow and make money out of it, or recover your cash. But if you have a land, say in Kitengela, and you want to sell this land, it might even take you up to 3 to 6 months to actually get a buyer, complete the transfer process, and receive the money. So that in itself is a liquidity risk. So what here you have to weigh is, what is the risk? Is it a default risk, meaning you won't get the money? Is it a shortfall risk, the risk that you may not get the money you may not get the return that you expected, or a liquidity risk that you may not be able to convert your investments into cash as fast as you would like. So you first weigh the risk and think about it. Is this okay for me? Am I okay investing in something fully knowing that it's going to take at least 2 to 3 years before I get my return out of this? If you're okay with that, which is called liquidity risk, then you can go for something that's giving you a commensurate return. So risk and return are commensurate. The higher the risk, the higher the return. But again, just so that we know, because when we talk about risk, most of us feel like I'm going to lose my money. So it's not necessarily losing your money. It's just the different types of risks that are there. Then risk appetite. What's your risk appetite, you as an individual? How I invest and how Rosella might invest and how Margaret might invest would be very different, because all of us have risk appetites, which are different. Risk appetite would be, number one, the ability for you to take risk. So generally we say the younger you are, the more risk you can take. Reason being, you have a lot more years to recover from the ups and downs of the market, and going through the recession and growth, different cycles of the markets, as compared to someone who's approaching retirement. So that's number one. Number two, the higher your income, the more risk appetite you have. So that means that if you lost a little bit more of your money, you're fine, because you still have some. But obviously the lower income you have, the less of a risk appetite you have. Then the other factors as well as how's your health, the number of dependents in the family. Obviously the more people depending on your income, then the less risk you should take. If you're a single boy or a single girl with no family, no one else that you're trying to provide for, then you can take high risk. So risk appetite again determines what type of investment you should go for. then available capital. Because there are different types of investments and the minimums are different. There are products which could cost about $10,000 in their cost, which the other investments which you can invest for as low as $10. So depending on how much capital you have available for investing, so you might want to buy say an apartment, but in Kenya a normal apartment would cost about $50,000 going up if you were to buy it in an urban center. Obviously, if you bought it in the rural area, it might be cheaper, but in urban areas like Nairobi, it would be like 50,000 USD and above. Now, if you have only $500 to invest, then it doesn't make sense for you to think about investing in real estate. Then you could go for things like mutual funds, or you could go for fixed income or for other structured products which fit into your budget. Then what's your investment goal? Now, goal is something very important, right? You're sitting down, you've decided you want to invest, but what's your end goal? Where do you want to head? What your destination is will determine which route you take. So the first thing you have to see is, do you have short-term goals, medium-term goals, or long-term goals? So list down all the goals you have, and goals could be: number one, a happy retirement; number two, I need to pay my kids' university fees in 5 years; number three, I'm paying for my high school's kids' school fees next term; number four, I want to buy maybe a car in 3 years; I want to buy a plot in 4 years; I want to build my own house in 10 years. So list down all your goals. Then break them down into short term, medium term, and long term. Short term is typically anything below 2 years, medium term is 2 to 5 years, and long term is 5 years and more. Now, the longer term your goals are, the more risk you can take. So for example, something that you need in about 30 years or in 17 years or 10 years, you can end up investing in high risk investments because you still have time for the market to go up and go down and still be able to make money out of your investment. Now, the shorter term your goals are, the low risk you should take. So for example, if you know you're paying your landlord some rent in 2 months, then it doesn't make sense for you to invest this in cryptocurrencies or any of the other investments that have high risk. So what you do, you'd go for something like mutual funds or like money markets, or even put in a savings account in your bank, because you know these are safer investments in a very short period of time. For sure, you know you're not going to lose your capital. It's going to protect your capital. Then secondly, shortfall risk. What's a shortfall risk? The risk that you will not get the return that you wanted. So you have to look at what your, and we can actually break down your goals into needs and aspirations. Needs are things you must have. Like for example, you know, when you're, I don't know, 60, 65, 70, and you choose to retire, you must have a house to live in. So that's a need for you. And you might want to go for a cruise after you retire. Now, that's an aspiration. Even if you don't get it, it doesn't significantly impact your life. But if you don't have a house to live in, that means you'll be paying rent and you may not have the income to pay rent at retirement. Your kids going to university, that's a need because you must pay them. Now, going on or buying a holiday home in Florida, that's an aspiration. So you have to separate the aspiration from the needs. So whatever you're investing in needs to be an investment that does not have much of a shortfall risk. But the things that you want to invest in, which are for your aspiration needs, you can put it in now more riskier investments, because even if you ended up not making what you expected it's okay because it was your inspiration in the first place, but not your actual need. Then what's your intention? Is it capital growth or capital protection? So capital protection is coming from the mindset of, I have $50,000 with me today. That's all I have. And I don't care if I grow rich, if my $50,000 goes into into $500,000, as long as I'm not going to lose my $50,000. So you have what you have and you don't want to lose it. And capital growth is coming from the perspective and saying, I have $50,000 today, but I want to grow my wealth. I want to become a lot more richer than I am today. And for this, I am willing to put this $50,000 to some sort of risk if it can help me make a lot much more money in future. So someone who is more likely to come from a capital protection perspective is if you're quite old, or you're approaching retirement, or you're already retired, because at this point it's very important that you protect what you already have, because it's not as easy for you to go out there and start earning as it was when you're younger. And also, for capital growth, this is for someone ideally who's young or maybe middle age, and they still have a lot more years before their retirement, and they are willing to put this whatever they have at risk to help them achieve much more money. So you have to also consider that, are you looking for capital growth or capital protection? Because whatever you're looking for will define what type of investments you go for. Because if you're looking for capital growth, things like stocks are good for you because they'll help grow your wealth. But stocks again are risky. But if you want something like capital protection, then you should typically go for bonds, because they will not make you much money. They might just beat inflation or just meet inflation, but for sure, you're not going to lose the money, so you're protecting your investment. So that's what to consider before investing. And then we go to, okay, so now that you've decided you want to invest, you've put down all the things. For example, this is my risk appetite, and I'm going for capital protection. You listed everything down. Now you need someone to walk the investment journey with you, and this person is called an investment partner. Different countries call them differently. Different countries have different qualifications. For example, in the US, you need to be registered as a financial advisor. In Kenya, you don't need to be registered to be a financial advisor. So you'll get people from all sorts of profession being a financial advisor. So depending on what country you're planning to invest in. So if you're planning to invest in Kenya, one thing you've got to be careful is, in Kenya, a financial advisor can simply be a salesperson. So yes, it's good for you to determine that, as much as they are salesperson, but do they understand the risk, the returns, the different complexities that this investment product has. So it's very important who you choose to be your investment partner, because if you end up choosing the wrong investment partner, it's just like the way you choose a life partner. If you choose the correct life partner, your journey in your life becomes much more smoother. If you end up with the wrong life partner, your life could end up quite messy. The same way, whoever you choose to walk the investment journey with you needs to be the right person. So how do you then choose the right partner? So the first thing you need to ask yourself, do you really need an advisor? And why we say you need to ask yourself is, there are people who already understand investments or are comfortable with investments. In that case, you may not even need an advisor. Secondly, maybe the sort of investments you've determined you want to do are very simple. Say all you want to do is just save for your pension, which which your retirement, maybe your company, your employer, whatever is paying for you, and you're just doing an additional contribution. Because the type of investment you're going to is just one thing, or it's pretty simple or straightforward, you really then may not need an advisor. Though I would still advise you, if unless you really understand investments, you should get an advisor, because you may think you don't need an advisor, or you may think that this type of investment is appropriate for me. But if you don't have the right investment background or investment acumen or experience, then you might end up cheating yourself that I really don't need an advisor, yet you do need one. So the first thing, determine if you really need an advisor. And if you're really good with investments and you experience in that, then you may not need. But if not, then it's good to have an investment advisor. Now, what type of advisor do you need? Now, there are two types of investment advisors. One is called a broker, and the second one is called a planner. So an investment or a financial planner is someone who will sit down with you and look at your whole investment life holistically. So they will sit down with you and say, okay, how much do you earn? How much do you spend? Who's in your family? What are your financial goals? So this is how much we need to save for your retirement. This is how much we need to save for your education. And they're looking at your whole financial life holistically. But a broker is a financial advisor from a specific firm. So for example, you want to buy stocks. So you'll go to a stock broker and they'll advise you, buy KCB shares because of XY reasons. Don't buy Safaricom shares because of XY reasons. So they're only giving an advice based on the stuff they do. And that's why they're called a broker, because they're just dealing in whatever they're dealing in, and that's what they're advising you on. But a planner will look at your life holistically. So then if you feel like you're comfortable, you can really figure out how much you need to invest and how much you need to make, then you can go to specific brokers to advise you for that asset class. But for the rest of it, you can just make your own plans. But if you feel you need someone to walk the entire journey from step one with you, then you should ideally go for a financial planner or a financial advisor. Then ask around, right? So, I mean, there's so many financial advisors out there. I'll give you an example. In Kenya, we have, I don't know, probably 100,000 of financial advisors. So how would you know who's the best financial advisors? And sometimes we make the mistakes of having our relatives be our financial advisors. You ask Uncle Joe, you ask Auntie Wanjiko, you ask, I don't know, Brother Onyango to give you advice on this and this. But they are not investment professionals. Just because they bought 2 3 plots somewhere, or just because they grew rich in some point, does not mean they are best placed to be advising you on finances. So you really need to look for someone who's experienced in finances. And when you ask around, the best thing is you ask people who are the financial advisors they use. So by word of mouth or referral, you can actually be able to determine, because these are happy clients telling you, instead of you getting someone off the websites or off someone who you've never had any interaction with and may not be able to advise you in the correct way. Now that you've chosen that person, let's call them Mary. Now that you've got Mary to be your financial advisors, there are some questions you need to ask Mary or figure out about Mary. The first one, are they restricted or are they independent financial advisors? Independent financial advisors means they're not restricted to a certain firm. For example, I work with Cytonn Investments, so all our financial advisors are technically restricted. So when they advise you, they will advise you on the best product given your circumstances, but they will only use the entire portfolio of Cytonn products. So our financial advisors are actually restricted. But if you go for a firm like, say, Vasili Africa, they're independent. They will advise you on Cytonn products, for example, ICA products, on Madison products, on whatever company you name it. So it's not bad having a restricted advisor, because they probably understand their products better than anyone else does. So that's one of the advantages. And then whenever you are investing with a firm and you have any issue, it'll be faster for them to be able to assist you with those queries. So those are the advantages. And for independent, the advantage they have is they have an independent mind. They're not only thinking of benefiting the firm they're working for, because now they're looking at all the different investments. So it's not bad to either have an independent or restricted financial advisor. The main thing is you need to know whether they're restricted or independent, because then it will help you understand the decisions they make, and you might know if there was some sort of bias in the decisions they are making. Then who pays you? Who is paying the financial advisor? Is it you as the investor, or is it the firms who are paying the financial advisor? So it's pretty much, if the financial advisor is being paid by the companies, then there might also be some sort of bias, in the sense that they might end up pushing products of firms that may be paying them a bit more commission than other firms. So that's one thing you also have to keep in mind. And again, it's not a bad thing, because a financial advisor can give you all the information, and it ends up cheaper for you, because you don't have to pay them all the time. So someone else is bearing the cost, but you also have to keep in mind that they make a commission. So when they're making, you sit down and also make a calculated choice. Then is it a one-off payment or ongoing? So supposing it's you who's paying the financial advisor, so are you going to pay them only once for them to give you a financial advisor and maintain their portfolio? Or are you going to be paying them every month? And it's important you know this, because if you don't know this, you might think it's costing me a certain amount today, and then come next month you are billed again. So it's good to know whether it's a one-off or it's an ongoing payment. And if it's an ongoing payment, then it's also eating into your return. So it's important that you work it out. If this is the return I'm making, but I'm paying X amount, then this is what I'm left with. Then how is your financial advisor available? Is it through phones? Can they meet face to face? Do they prefer meetings? Can they respond to you? You know, you need to know how actually your communication would be happening. And there are people who prefer meetings, you know, sit down, write on a pen and paper, have coffee, discuss these things in an official manner. And you might not be able to have this luxury, maybe because you're working 2 3 jobs, you don't have the time, everything, so you want someone who's easily accessible on phone. It's good to know how accessible your financial advisor is. Then credentials. Credential is very important. Like I told you, in Kenya, a lot of financial advisors may actually just be salespeople with no technical knowledge as far as investments is concerned. So it's important that you know what sort of investments experience, credentials they have. Do they have some financial qualification? Do they have some investment qualification, and what exactly is it? Is it recognized in Kenya? Is it recognized globally? So you need to know. Then what's their experience? Are they new in the market? Have they been there for years? And when you look at a financial advisor, you don't have to see how new or old the firm is, but the individual themselves. Because someone could have started a company 3 months ago or 6 months ago, but the individual themselves have like 15 years of work experience. So that means they're in a better position to advise you than a firm which might have been there out there for 3 years, but the individuals working in it have an experience of 6 months. So it's important that you look at the individual financial advisor's experience. Then what's the specific expertise? Now, the different types of investments, which we'll go into shortly, but depending on whatever sort of investments that someone is going into, there's stocks, and there are people who are experts in stocks. There's fixed income and bonds, and there are people who are experts in that. There's real estate. So are you looking for someone with a specific expertise? If yes, then when you're looking for a financial advisor, then that financial advisor should have some sort of expertise in that field. Generally, they should, it may not be in the form of credentials, but they should be good enough in their knowledge about that certain types of expertise. Then, do you deal with the financial advisor only, or will you be dealing with other people in the firm? So for example, if you invested in a firm like Cytonn and I'm your financial advisor, will you only be talking to me? Or if there's an issue, will you also be talking to other people? Sometimes it's good to have someone who you will be talking to directly, because they end up being some sort of relationship manager. Whenever you have an issue, you know, they're the to go to person. They understand your investment portfolio entirely. In case of anything wrong or right, they would be quick to alert you. So it's good to have someone who deals with you. But sometimes you also need to know, in case you can't get them, or if you can't reach to them, will you be able to reach out to other people in the firm? So it's important to know that as well. Then how often is your portfolio reviewed, right? So they sat down and they did the initial analysis. They looked at your risk, your returns, your goals, and they advised you that this is what you should do. But circumstances change, right? So typically, a financial advisor should be analyzing your portfolio every year, or earlier if there's a change in circumstance. What could be a change in circumstance? Right now, there's a COVID environment. A lot of people have either lost their jobs or have got a significant pay cut. So if you're one of those affected, then technically your portfolio needs to be relooked again, because this means whatever you had planned for may not turn out the way it was. So you might have to relook at the investment portfolio and see how it's going to change. You might be getting married, or you might lose a spouse, or you might get kids. So all this ends up affecting your financial financial life. So you need someone to sit down with you and say, okay, now there's the circumstances have changed. How does this change your portfolio? So that's the other question you should ask your financial advisor. How often will you be reviewing my portfolio? Then there's something that's very difficult to understand or to describe, but there's something called general fit. And sometimes it could be cultural. Do you come from the same cultural background? And by cultural background, I mean not necessarily mean, are you a Kikuyu, or are you an Indian, or are you a Luo, or what are you? Yeah, it could just be something as, do you have the same set of behavior? Were you brought up in the same manner as your financial advisor? Do they understand your lifestyle? Do they understand why you're investing? Do they understand why you do what you do. Because I think it's like a very it's a very nice Kenyan culture where we end up supporting our siblings and family, which could be difficult for a non-Kenyan to understand. So if you have a financial advisor who understands that these are some of the things we do as Kenyans, we support our brothers, our siblings, even people from our town, you know, there are things we do that other cultures may not do. So do you have a cultural fit? Then ethics, do you both have the same ethics? Do you believe in the same thing or no? Because this person, then if you don't have the same cultural fit, or you don't have the same ethical way of looking at things, like for you maybe think that maybe investing in firms, in companies that maybe sell tobacco is a sin. But if your financial advisor doesn't believe that, then they may not be able to advise you. So are they aware of what your ethics are, and are they able to empathize with it? Can they put themselves in your shoe? Because only someone who can put themselves in your shoe and understand your situation will be able to advise you correctly. Then timings, right? A lot of people work sometimes day shift, night shift. Maybe you work 2 shifts, maybe you work 3 shifts, you have kids, you know, you've got to drop them off, do this, do that. So is your timing and your financial advisor's timing same? And by saying same, it doesn't necessarily have to be same, but how flexible are they? Are they willing to stay up late at night to speak to you because that's the only time that works for you? Are they willing to respond to you on WhatsApp? Can you text them at any time and call them at any time? And are they responsive to you? So all this, I put it under general fit because it's something that it's not a rule. No one will, you know, there are no rules and regulations or know-how. But when you meet a financial advisor or you speak to them on phone, you will understand that there's a general fit between you and your financial advisor. You know, they're there. Even if you text them at 2 a.m., they may not be awake, but as soon as they wake up, they see your message, they're going to respond to you. They understand that you are busy and you don't have time for doing things in a particular way, so they are there to advise you. So that's for choosing a partner. And now we go to what are the different types of investments in Kenya. So the first one we have is stocks. Excuse me. So stocks is simply buying a share in a listed company. So we have in Kenya, we have the Nairobi Stock Exchange, and that's where all the listed companies are. So when you buy a share in a listed company, there are two things you expect to get out of it. Number one is a capital appreciation, which means you buy a share at 50 bob, and in a few days it's going to cost 55. So that's called capital appreciation. You've got 5 bob on top of your initial investment. Then the other thing is dividends. So you can make money out of dividends. Maybe your share price doesn't increase as much, or maybe it does, but you still get additional dividends paid on it. So you buy a Safaricom share, and you know at the end of such and such a day or month or year, I'm going to be paid an X amount of dividends. So that's income that you get from your stock. Now, the thing about stock is, number one, is highly liquid. That's one of its characteristics. It's highly liquid, meaning you can buy at any time and sell at any time. So it's very good for someone who's investing and they need the investments to be liquid, that they can sell them off at any time and recover their money. Then it's also good for people who are looking for high returns, because stocks have high returns. But also remember, we said initially risk and return are commensurate, so high risk goes with high return. Now, the disadvantage of a stock is it has no capital protection or principal protection. You might buy a share at 50 bob, and then the company just performs terribly over the next few years. The next thing you know, it's 3 bob. So you've actually lost 47 bob, which you will never recover. And that's just how stocks function. Or you might buy it at 50 and the price may go up to 75 and you might make good money out of it. So stocks are high risk, they're liquid, they have both capital appreciations and dividend income. Then there's fixed income. Fixed income is simply any sort of instrument that gives you a fixed income in the form of interest periodically. So it could be monthly, it could be quarterly, semi-annually, or annually, but at the end of every particular period, you're getting some sort of interest out of this product. Simple examples could be term and call deposits. We call them fixed deposits in Kenya, but there's term and call deposits. Call deposits meaning you put your money in and you can withdraw it at any point in time. And term deposits are actually fixed, like you can invest for 6 months or 9 months and you can't withdraw your money before then. So when you're investing at the outset, you know you're investing for a year or 2 years. Then there's government securities, which could be treasury bills or bonds. So whether you invest in bills or bonds, whatever it is, but you know at the outset that you're going to get a fixed return periodically. Then there's bonds and commercial paper. So bonds could be issued by the government. In Kenya, they are typically 10 years and above. Or you could invest in a company or a corporate bond, which is a way corporates actually borrow money. East African Breweries is an example of a company that issues bonds. So they borrow money from you by issuing you a bond. Then there's commercial paper. Commercial paper is also sort of a corporate bond. Now, bonds can be both government and corporate, but commercial paper is usually by corporates and it's usually short term. So you will see that commercial papers are less than 1 year. A company comes out and borrows money from investors, but it pays you back within a year. So that's called a commercial paper. If it's more than 1 year, it's usually called a debenture. So then there's real estate. So real estate is a loved topic in Kenya. We all love talking about maploti, nimenunua ploti huko, ule amejenga pale, you know. It's a very good investment in Kenya. You can make quite some good money out of it, but it's also got some disadvantages. Number one, it's illiquid, meaning you can't easily get out of it. If you want to convert your plot into money, because you may need the money, it may take you a few months to convert it into money. So it has liquidity risk. And then it has shortfall risk in the sense that you may invest expecting that your tenant will pay you, say $1,000 every month. Then what happens is you get a tenant who is not supposed to pay, who doesn't agree to pay you 1,000. You only get someone who's going to pay you like $800, right? So that's one of the risks. The other risk is you might get a tenant who will stay in your house for 6 months and only pay you for the first 2 months, and then after that, no rent, nothing, you know, they just disappear over the ground. It happens all the time in Kenya. So that in itself is a risk. You may not get the return you expected. But having said that, real estate is a good investment, especially if you're looking for a long-term investment. Because it's riskier, it's good for a long-term investment. If you're buying a home towards your retirement, it's a good type of an investment. So you can actually invest in real estate by buying a plot, then unajenga mwenyewe, or you can just buy an apartment, give it out for rent, or you can buy an apartment and then after some time sell it, or maybe you're planning to come back home to Kenya. You can do that. You can put it up on Airbnb or do whatever it is that you like to do. Then there's private equity. So remember we said stocks and then we said private equity. Now the difference is stocks is buying a share in a listed company. Private equity is buying a share in a company that is not listed. So for example, if you wanted to buy a share in, say, Vasili Africa, Vasili Africa is not a listed company. So what this would mean is you'd buy a stake in the company, and they would probably promise, and I don't know, maybe Rosella has no intention of selling, but I'm just giving an example. So what you would do then is someone can buy a share or a stake into the company and they would get a certain return from it. But because it's not listed, there are some characteristics that come with it. Number one is it's illiquid. It's not easy for you to get out of your investment as fast as you'd like, because there's nowhere, no stock exchange or no website where you can go and start advertising this stake that you have in the company. And the other thing is it's usually very high return, so you can make very good money out of it, though there is no transparency, in the sense that you might decide, for example, to invest in your brother's matatu business. And maybe when you started investing, he told you, give me $3,000, I'll put in my matatu business, and every month I'll be giving you, say $100 is a return. So you agree, and that's a sort of private equity, only an informal one. But then how do you know whether $100 is the right amount you should be getting, or $500 is the right amount you should be getting? Because there's no place you can actually go and see how the transactions have been historically carried out. So there's a risk that you might underpay, and there's a risk that, there might be a risk that you might overpay, but there's a benefit that you might also underpay, because there's no transparency of data. There's no way you can go and see transaction details. So that's how private equity works. You can invest formally and buy shares in a company that is not listed, or you can invest informally, maybe by investing in a brother's or a sister's or a friend or any other, investment opportunity that is out there, by investing a sum of money for which you expect a return. Then there's structured products. Now, structured products are simply what they say to be, what they claim to be. They are structured. So they are neither stocks, nor are they fixed income, nor are they real estate, nor are they private equity. But it's a combination of these different products to create, they're combined and structured to create a totally new product. So there are many out there in the market. I'll give you a simple example of one of the products we have at Cytonn. It's called Cytonn High Yield Solution. So you can invest, say, money for 1 year and get 18% per annum. And out of this money that you get 18% per annum, about 80% goes to real estate. And then out of the remaining 20%, it's split between stocks and fixed income and, commercial bank fixed deposits, government securities, and everything. So you see, you can't say it's real estate, but you can't also say it's stocks or fixed income. It's actually diversified over all these products to give you characteristics of all. So you will get you'll be getting maybe a quarterly interest out of it, which is an advantage of a fixed. It's a characteristic of fixed income that you get periodic interest, and it's also giving you a high return, which is a characteristics of real estate. But also the return that you're getting is fixed; it's not varying. So it's also giving you characteristics of everything. So it's just someone who takes the money and creates a product that is could be including a few or all of the different types of investments in different proportions to create a totally new product. So that's what's called structured product. Now, so now that we've gone through the types of investments, how to partner, and what to consider before you invest, we need to consider some of the challenges we face when you're in the diaspora and you're trying to invest back home. So the first one is lack of information on products. So because you're out there, there's a time difference, you're not physically in Kenya, you may not know what's the best products that are out there in the market and which ones are good for you and which ones are not. Then lack of trustworthy partners. So even if you did find a good product, say you decided to invest in a structured product, but who do you work with? Who is it? Someone you trust? And unfortunately, I think as Kenyans, we don't have a very good reputation with Kenyan diaspora, because we tend to think that Kenyans in the diaspora make a lot of money. So when they send back money home for investments, we end up using it for our own benefits and not delivering what we'd actually promised. So that tends to be the situation. So it's very important that you find a partner you can trust. And a lot of people have been disappointed even investing through friends and brothers and sons and fathers and everything. So it even gets more difficult if you're investing with an institution that you don't trust. So you need to look for a partner who you're sure will not steal your money or will always act in your best interest at all times. Then even now, if you do find that partner and you've identified the product, then now you need to transact the money, send the money back to Kenya, or if you have it in Kenya, transfer it to the investments account. So to do this, it's also tends to be an issue with the transaction itself. So sometimes local companies, actually, I don't think, at Cytonn we do have a US account, but I think most of the Kenyan companies don't have international bank accounts. So it's difficult for someone to transact from their country through their country bank. So anything, then they have to actually do an international wire, which can end up being expensive and it ends up taking time. So there are usually issues also with doing the transactions itself. So it's good to also look for a company that you can transact with wherever you are. Then different service levels. It's Kenya, it's a developing world. Our service levels are not the very best. We have good products, we have very good returns, but sometimes our service levels can be wanting. So especially if you're living in the first world and you're used to expecting a certain type of service level, that when you raise a complaint, it will be addressed within 24 hours. And, if things don't work out, you'll get a refund, something like you go to eat a burger and it's not cooked well. And they say, okay, 50% off and a soda on me. but you'll never get such things in Kenya. I mean, one day we'll be there, we're hopeful. But as far as today's, our service levels can be wanting in a number of areas. So that's one of the challenges I have noticed a lot of my diaspora clients face, is they just feel very frustrated. They feel like they're hitting a dead end because the service levels, with the other institutions, they might have opened a bank account and the bank guys don't respond to them for days. They try to process a loan, it takes 6 months to 1 year. So they really complain to me and tell me, hey, you guys, I don't even know how you guys live in Kenya. It's just very frustrating to get anything done. So it's just the way things are. I think we've improved tremendously over the last few years. We are still not there. We have a long way to go, but it's good to know that it could also be frustrating. So that brings us to the end of our investment training session today. And I guess we can then now have question and answer session, and just to be able to address any questions you may have. So feel free to chat. There's a chat functionality. So feel free to chat if you have any questions, and happy to answer to the best of my ability. So I'll just mute briefly as you send in those questions.
Hi, Hetal.
Hi, Rose.
There are a few questions. Thank you so much for taking us through the session. There are a few questions that have come in. And for everybody who had joined us earlier, Pole sana for the mishap that had happened earlier. And now we are back on track. There's a question number. Please shed some funds and money market funds.
Sorry?
Please shed some light on mutual funds and money markets.
Okay.
The other question also on money markets from Evelyn Mushiri, it's is the interest only once a year, or do we have a monthly amount earned?
Maybe we can take 3 at a go.
Yeah. The other question is, please repeat the name of the example of the structured products available at Cytonn.
Okay.
Yes.
Okay, great.
So share those ones first.
Yeah, so we'll take 3 at a go. So I'll start with the first one, money market and mutual funds. So there are different types in Kenya, and obviously there are different institutions who do them. Cytonn is just one of them. There's Nabo Capital, there's ICEA, there's quite a number, Britam. So mutual funds can be different. We have more of unit trust in Kenya. So you can get an equity fund or a balance fund. So equity fund is where all your investments, or everybody invests, we pool them. So everyone puts a small amount and it's pooled together and it's invested all in equities. So they could be different equities, but they're still equities. So that's called an equity fund. And then there's a balance fund where 50% goes to equities and 50% goes to fixed income. So all the pool money from investors goes there. And then there's money market. And money market is sort of a diversified investment. So I'll take a simple example of the money market funds that we have in Kenya and give you the features, because it will answer also question number 2. So the minimum amount you can start with if you're in Kenya is 1,000 Kenya shilling, which is like 10 USD. So you can transact through your phone using something called USSD. So if you have an M-Pesa line, you can directly transact from your M-Pesa or from your bank into your accounts. The interest is paid monthly and it's compounded daily. So every day that you have money in your account, whether it's principal or interest, it's still earning interest. So if you don't withdraw your interest and it remains in your account, it keeps accumulating. Then the good thing about money markets is you can invest at any time and you can withdraw your money at any single time. So there is no lock-in period, and it's quite pretty flexible in that way. The rates fluctuate on a daily basis. We've seen 11.3 to 11.1 over the last, say 1 year. We've seen an average of around 11%, 11 point something percent. And this year, some days we have 12%, some days we have 10%, but on average we expect to be getting something between 10 to 11% per annum. So that's the interest rate you should expect to get. You will be charged 15% withholding tax on the interest. And this withholding tax actually applies to any type of investment. I mean, most of the investments where you earn interest, whether it's your savings account in a bank or wherever, but there's always 15% that's deducted at source. And yeah, so interest is paid monthly, it's compounded daily, and you can invest at any point in time up to 300,000 Kenya shillings, which is like 300 USD. You can actually, sorry, 3,000 USD, you can actually withdraw instantly in the day, and it can go directly to M-Pesa. Now, if you are in the US and you want to invest in our banks, we do have a US account. Now, because we are going to wire the money from our US account to our own account, so the $1,000 or the $10 minimum amounts don't apply anymore. So we have a minimum of $100 just because it becomes very difficult to keep wiring small amounts of money to Kenya. So you can invest as low as $100 and still be able to earn the same return. So we'll just send it back to Kenya at our own cost and convert it. But if you're in Kenya, you can do it from your account, from Airtel, from Safaricom, M-Pesa, whatever it is. So those are the features of money markets. The structured product I had mentioned is called CHYS, which is short for Cytonn High Yield Solution. We've got another product that's called Cytonn Project Not, which goes 100% to real estate and gives you 20% for 2 years. Sorry, 20% for 19% for 2 years and 20% for 3 years. So if you invest for 3 years, this means you get 20% in year one, 20% in year two, and 20% in year three. So over 3 years, you'll get 60%. You'll be paid your interest quarterly, and it is again subject to 15% withholding tax. For the Cytonn High Yield Solution, you can invest for 3 months, 6 months, 9 months, or 12 months. The interest rates vary depending on what period you go for. So for example, 3 months is 15% per annum and 1 year is 18% per annum. But whatever the case you go for, whether it's 3 months or 6 or 1 year, whatever interest rates we agree to invest you at remain fixed for the entire period. So until your investment is not over, you will still keep earning the same returns, regardless of the product or of the markets going up or down. So that's the advantage, but then the disadvantage is it's pretty inflexible, so that this means that if you invested for 1 year, come 11 months and you want your money back, or 10 months and you want your money back, you will not be able to access your money until your investment has matured. But for money markets, it has a much low yield, about 10 to 11%, but the advantage is you can attain your money quite easily. And this is now the example of where I was saying you need to look at your financial goals and see, are they short term or are they long term? Because if they're short term, then money markets is a good product for you. Are they long term, then maybe the high yield solution is a good product for you. Then how easily do you want to access them? If you really need to access your money back at any point in time and you want that flexibility, you can go for the money market. If you're happy to put your money tucked away and safely know that it's okay, even if it's 1, 2, 3 years and I don't get my money back, it's still earning me money, I'm okay because I have other things that are keeping me going, then high yield solution is a good example. Yeah.
All right. I think I combined that question with one that has been asked by John just now. He says he's a member. He's already a member in CMMF, Cytonn Money Market Fund. I can see my cumulative interest daily. Now my question is the money I see daily less all charges? All charges, I mean government taxes and management fees.
It is net of management fees, but it is not net of, and I don't know, I'm not sure where he sees, because we have different platforms. But if you go, for example, online, it will show you the gross before tax and then the net after tax. So whatever you're seeing, if probably it's on your app or something, it's before tax, because the only point you're paying tax is when the interest is actually accumulating, but it is net of any management fees. So whatever you're earning is after the management fees, but you're still going to pay tax on it, 15%.
Okay.
Yeah, but on the interest, not on the principal.
Okay. John, he views on the app, but John, I hope you have been answered. The other question on Cytonn, Evelyn, I'll get back to you. For Cytonn high yield solution, is my initial capital protected, or can I lose my initial capital depending on the market fluctuations? That is from Margaret Sanya.
Sorry, I didn't hear the money market bit. You said if the initial capital in CHYS is protected, and then what about money markets?
Or no, there was no money market.
Okay.
For high yield solution, is my initial capital protected,
okay,
or can I lose my initial capital depending on the market fluctuations?
Okay, I got that.
All right.
Any other?
The other one was from Evelyn earlier. The question was, how do you gauge the stability of an organization that you want to invest through?
Okay. Okay, great. So for CHYS, it is principal protected. Same with the Cytonn money market funds. All the products are actually principal protected. So even though the interest fluctuates for money markets and for CHYS, even it doesn't fluctuate. But in either case, both products, you have your principal, which is protected. So you can't lose your principal.
All right.
Yeah. Then for the stability, how do you gauge the stability of a firm that you want to invest? So there are lots of things you need to look at. One, you need to see where are they investing this money? Are they investing in things that are stable, or are they investing in things that could fluctuate? Because if they're investing in things that could fluctuate, that means that your investment also runs the same risk that the investment runs. But if they're investing in something like, say, real estate, which is something that's stable, then you know that even the interest, even the investment that you've invested is in a safe place, so you're safe. But now, whatever they're investing in, look at their balance sheet. How much, for example, if they're telling you, for example, I'll give you an example of Cytonn. We're telling you we're investing in land. So how much in value of land do we have? And how much of it is funded by debt? So if you take debt away, is there any equity in the farm? If there is, then it's relatively a safer farm. If there's no equity and it's totally everything is reliant on debt, so that means there's a higher risk. And then secondly, in countries like Kenya, you have to look at the corporate governance. So it's very important to see the sort of management that the farm has. If you trust the management and if you feel they're running the farm well, then there's a higher chance that your investment will be safe. If they seem not to be very responsible with their communication to clients, they're not very straightforward, they're not transparent, then that also tends to be a risk factor.
Okay. We shall share the presentation after this. For those who joined us late, if you have any more questions, kindly keep them coming before we close in the next 5. There's a question from Margaret again. What is the minimum principal required for Cytonn high yield and Cytonn project note? It's not Cytonn logic note, it's Cytonn project note. That is from Margaret.
Okay, so for Cytonn project notes, the minimum is 1 million Kenya shillings. And for Cytonn high yield solution, it's actually from 500,000 and above Kenya shillings, you can get the 18%, but you can invest between 200,000 and 500,000. The only catch is then you will get a bit less interest, so you get 2% less. So instead of 18% for a year, you end up getting 16% if you invest between 200 and 500,000 Kenya shillings. But if it's 500,000 and above Kenya shillings, then you actually get 18%. So the minimum is, for the same rate, it's 500,000. But if you're willing to go a bit lower, then you'd have to, take a bit of lower interest rate as well.
Okay. And just to get a clarification from you, Hetal,
yeah,
on the investments, on the money market funds investments, the minimum amount for dollar is 1,000, equivalent to 1,000 shillings, Kenya shillings.
No, it's $100, so it's 10,000.
Okay.
Yeah.
And now the Kenyan shilling is, some funds have 100 shillings, some funds
Yeah,
have, yeah.
it's 100. It's low. It's as low as 100. We used to be at 1,000, but then at some point we went down to 100.
Okay.
Yeah. But you see, with 100, you have to also take into consideration the transaction fee.
Yes.
So yes, it's there, but practically it's not recommended, because then you're paying like 3.6% just in interest. I mean, in transaction
In
charges. So it doesn't
transaction
make sense.
charges.
Yeah. So it
Yeah.
doesn't make sense. Yeah.
Mm.
Oh, and the beauty about our money market fund is you can actually pay DSTV bills, you can pay Zuku bills, you can buy your airtime, you can buy KPLC using the money market fund. Now, I have the beauty, the other thing I've seen about it is when you want to pay someone who has an M-Pesa account and may not be a Cytonn client, you can pay from your money market to an M-Pesa account, and it's actually cheaper because it's 26 bob for like up to, I think, I'm not sure, but I think I've transacted up to 10,000 so far. In all, it's charged me is 26 bob. While with Safaricom M-Pesa, it ends up being more expensive. So you can even use it as your M-Pesa account to be paying people. You know, sometimes, especially if you're out there, you want to, you know, send money to, I don't know, your mother or, you know, your brother, or you need to pay for something back home. You can actually use your M-Pesa account, because it's online as well, to pay to someone down here locally. And it just works like the M-Pesa in paying. It's actually an M-Pesa account that earns you a better interest.
All right.
Yeah.
So for Cytonn Money Market Fund, it actually works as a wallet. That's
Yes.
that's basically it. As Hetal said, you can pay your bills, so you just transact directly for the bills, and they are also very convenient when it comes to withdrawals. It's almost an immediate withdrawal, so you you use your USSD code if you're in Kenya, or you can fill in the online form, and the money is sent to your, to the number that you want, whether it's your mobile number or someone else. So there's a question from Salamba. How do I open an MS account? I think that's money market fund account, Salamba. Yes, money market fund account. So I think it depends with different companies. For Cytonn Money Market Fund, there is, if you're in Kenya, there's a USSD code that you can use. That is *809#. Or you can fill in a physical form, or you can fill an online form. For some other companies, now I'm answering as an independent agent. For other companies as well, they have their online forms as well. For some you don't need to fill in the physical form. For some you need to fill in the physical form. So you can reach out to us, you can reach out to Hetal if it's Cytonn Money Market Fund, and we can guide you.
And I'd actually recommend if you went through Rosella and team, and the reason is because you see they're an independent agent, so they would actually give you the pros and cons independently for all the different money market funds. Obviously, I'm a Cytonn employee, so I'd encourage you to go for the Cytonn products. I think we have very good products, but working through Rosella then helps you get the different products out there in the market, the pros and cons, because she can tell you the good things and the bad things about all farms. I cannot, because I work for a certain farm, so I will always pick. But definitely, having said that, I invest in all our products, and I will tell you the excellent products. It's good to go through an agent who can then be able to show you the pros and cons of all the products and guide you through the process.
All right, thank you so much, Hetal. So Salamba, looking forward to hearing from you. I'll send you our contacts after. Then there's a question from Brian. Is there a certain constant amount of money required to be in one's money market account, money market fund to run the wallet?
No.
Right. So you can withdraw, I think you can withdraw to 0, and then you can top up, because the minimum amount is, I think, 100 shillings.
Yeah, so it
but you have to meet the transaction cost.
Yeah.
Yeah. All right, any more questions? As I said, we shall share the presentation after this. Hetal, you can share your contacts as well. for people who would like to reach out to you?
Let me just chat it so everyone
Yes.
can see it.
All right.
So I've shared both my number. It's available on WhatsApp as well as my email. So feel free to contact me in case of anything.
Okay, let me just copy it. You've shared to me privately.
Oh, I'm sorry.
Let me just copy it to everyone.
Okay, no worries.
That's her number, her email as well. Let me share it. There's a question. Okay, Margaret, yes, we shall keep you posted on future webinars. We will be having some more with Hetal and other people come in the coming weeks. At least we close the year on a high. We put our financials in order and close the year on a high. I think the COVID season came for us to be able to focus on what really mattered to everybody on a personal note. Most of the time, I think the years before, people were swaying with the crowd. What makes sense? What is my friend investing in so that I can invest in? So my friend made money somewhere, not realizing that you're not your friend, you're your own individual person. As Hetal had mentioned earlier, you need to actually figure out what is your investment goal, where do you want to be in the next 5 years, or in the next 1 month, or in the next 2 years, yeah, so that you can be able to focus on your own individual journey when it comes to investments. And we are here to help you. So asanteni sana for being with us today, and hope you're keeping safe wherever you are. Wear a mask, sanitize. Yes, and let's also teach our children how to be financially free. Thank you so much.
Rosella,
Yes.
before we leave,
Yes.
I think you need to have a session for junior.
Yes, we shall have a session for junior, and I think you're the one who's going to take us through.
Oh dear. Sure, happy to. I have 2 young ones, so I can use experience. Thank you.
All right. Thank you so much. We are free to leave the meeting. Asanteni sana.